Good morning. So as Brendan introduced me, I'm the CEO of Tokenized, and we've been in this journey, or BSV's journey, since the beginning now. So it's been a long, hard battle, but times are very exciting at the moment. So we've got some exciting things to share today, but I really want to talk today about smart contracts and really sort of frame what they mean and get the terminology correct, and then more importantly, look at the value proposition. So I would sort of controversially say or start off that pretty much everyone in the industry we think has got it wrong, and the way they call contracts today, contracts are just not contracts at all. So for example, Ethereum, they call fundamentally at their protocol contracts. Even Vitalik himself years later, I think it's about 3 years ago, admitted that they're actually not contracts, and it was really poorly named. So today what we've done is we take the same kind of components, the machine readable, machine enforceable code that you see on distributed ledgers, and we take that standardization, that codification, but we build that as a very tiny piece to the overall puzzle, which is a contract, which is lawful, precise, judges can read it, interpret it, lawyers can make sense of it, normal people can use it, and there's a great deal of value to be derived from it. So the key sub-theme here is improving financial markets through a digital transformation of contracts. So that's the heart of it. And I think tokens get a lot of undeserved credit for being transformative. I think tokens are exciting, but they're a very, very small piece of the puzzle. And when you compare tokens on DLT to existing traditional financial technology or infrastructure, it's not that big of a jump, right? There are some properties that are better, but we think it's very small in terms of, it's not a 10x jump. But when you bring contracts into it, and you bring a digital transformation of contracts, this is what we're talking about, 10% or a 10x jump. All right, so just to kind of frame the problem a little bit better, so there's a trend that's been very apparent over the last 10, 15 years, and that's a move away from public markets. So companies are IPOing less often and staying in the private markets longer, and in many cases, they're remaining private for longer. And there's a number of reasons for that, which I won't get into, but the burdens in the public markets are high, the costs are high, and the benefits to delivering and executing on businesses is actually quite high as well. So this is a trend, but even more importantly is that private capital markets are much, much bigger than public markets. So not only is the trend growing, but it just starts off much bigger. And when I say private capital markets, I mean startups, I mean private equity, I mean private debt, I'm talking about municipal bonds, I'm talking about bank accounts and instruments that banks issue, and many, many other things too, even carbon credits and things like that. So the problem in the private capital markets is that there's a low level of digitization. Or poorly digitized in the way of describing it. So if you think about your typical transaction or your contracting process in these private capital markets, it's paper-based, and it may be Adobe PDF, it may be DocuSign involved in the signature processes, but the actual document itself isn't interpretable by computers. So it's very, very human readable only, and this usually requires specialized lawyers and the like to kind of process it. And it's just a big pain to kind of process it and figure out what you're actually dealing with and what the risks are. So this is where that digital transformation of contracts comes in. So ultimately, this poor digitization leads to inefficiencies around the capital formation. So that's really just forming capital, taking investment, putting it to use. Asset services. So asset services are if you're an investor and you're an equity holder or you've lent money, you got to get paid a return. So you get dividends, you get distributions, you get coupon payments. So the asset servicing is really about delivering that return, so the actual mechanics of it. And then also in addition to that is dealing with sort of the terms and conditions or your rights. So if there's a change to the company's business plan or if there's certain changes to the actual structure of how it's owned, you got to vote on it, and there's elements around that. And then the secondary market is all about trading those interests. So going to the public markets, trading with someone else, they pay you money, hopefully at a return, so you've made some money. But it's a critical part to the functioning system, and it really reduces the overall investment risk if you can sell it. So our smart contracting platform utilizes blockchain. So that's the fundamental layer. Every single part of the contract is stored on chain. So it's not just a token, it's not just a little bit of code, this is everything, all the terms and conditions. A good chunk of it, based on what we've done in our protocol, is machine readable and is machine enforceable. That's a really critical part. That's where the automation comes into it. That's a really revolutionary part. But there's also parts in contracts you just cannot make machines make sense of. So an obvious example is like a non-disclosure agreement or a confidentiality clause. Many, many contracts have this. It's a really important part of business. But how does a computer know what someone has said in the real world at a private party, right? Like it just doesn't happen. So you still need it there, and there's benefits to having it in a structured digital format that allows the people that are interacting with these contracts to recognize these rights and remind them of it and manage those risks. But you can't really have any code sort of act on it. The key part here, I think, is what really makes this viable is the BSV's properties, the things that we think are unique to BSV. So this is extremely, extremely performant, really, really, really low cost, and scalable. So you can get every single commercial record across every single deal in the world, all on it, and you can do it for extremely, extremely cheap. So when you're putting a contract on and you're amending it or you're performing certain functions, we're talking less than $1. We're talking really 5 cents, hundredths of a cent, these types of costs. And again, if you go to any other network or really any of the networks that are popular at the moment for this kind of thing, you're spending hundreds of dollars, thousands of dollars in some cases, and it just becomes unfeasible. So this is kind of a way of thinking about our architecture and what a smart contract is, and even thinking about it a little bit more broadly. So we see smart contracts as the buzzword, the key part, the anchor of this whole revolution or digital transformation. But there's a lot more little pieces involved to make this really compelling. So this is where I actually like to use the term commercial records and bringing all the participants that kind of go into regulating, enforcing, administering the contracts. So you can see here we've got some technical concepts like identity oracles, authority oracles, event oracles. But really what they represent is a technical service, an interface for regulators or regulated entities, for example, to perform their functions. So in the case of an identity oracle or authority oracle, you're basically permitting within the smart contract that these services can perform functions like freezing a token, confiscating a token, or unfreezing a token. Those are the core pieces for an authority oracle. And that might sound offensive to some people that have certain ideologies or a certain ethos in this space, but we would suggest that it is critical, absolutely critical for property rights to be enforced. So for example, the most obvious example would be a court order. Right? So if someone has, if there's a dispute and a court has decided that some person gets the tokens and the person is unable, maybe they lost the keys or maybe they just refusing to comply, you need some mechanism, some way for authorities to take control and correct the ledger so that it reflects reality. If you don't have that, what you have is a ledger, a source of truth that doesn't reflect reality. So you have this ledger that doesn't mean much, and you have to have side chains or separate databases that other people control that kind of correct the inconsistencies on chain, and then you've kind of defeated the whole purpose of having a distributed ledger. So it's really critical. And also by doing the structure and bringing these people into the fold, you can increase automation, and you can increase transparency and increase accountability. So if you have, for example, a regulator, for example, who is acting not in good faith or not according to the rules, it will be obvious to everyone that they've broken what they should be doing. They're not acting in good faith because they can see the full records of their actions and the justifications behind it. So it's really creating a much more transparent system that brings everyone into that scope. Over on the left-hand side or right-hand side, you see the smart contract agent. So this is the core logic. This is the software agent that's performing the functions related to administering the contract. A way of thinking about this is really a software version of a lawyer or a transfer agent or some type of professional like a secretary, company secretary, where they're actually managing the registers, managing the contracts, taking requests through email in a traditional sense, and then if they're allowed to do it, they'll go and make changes to the contract. You can automate a lot of that, and that's what that smart contract agent does. But there's still parts where you need an actual representative from the company to make changes that kind of represent the interests and wishes of the company as well. So that's where the contract administrators come in. So this might be like a director or an executive, some kind of individual senior, and they'll make changes directly on chain. So they'll amend the contract. And again, this is just how business goes. These are real concerns, these are real needs. And by doing this architecture, again, you're bringing everyone into the fold. Everyone has a standardized way of interacting with it that everyone can interpret. They don't have to look at non-standardized contracts that have totally different terminology, totally different structures, and things that are quite confusing and conflicting. So this brings a lot of clarity to the whole process. And then, of course, you have token holders. So token holders are really, as we all know, people that are holding tokens in the digital wallets. And I think the better way to think about this is really instruments. So financial instruments, shares, bonds, coupons, things that represent some rights or duties in the contract. and those are things of value. So that's what you really want, is the right to be paid a dividend. That's why you care about holding a token, and so that's what that's all about, but it connects it up to the contract itself. So everyone has the things that are most meaningful to them all recorded and standardized in a way that's much more efficient to kind of understand. So this is kind of taking a broad view of sort of the mechanics and the architecture of what we've done here. So the example here is a municipal bond. So a municipality issuing, let's say, some debt to build a bridge or to improve some kind of element in their municipality. So you've got the actual smart contract itself, specifies all the terms and conditions and who's involved and what kind of control features are available. Then you got the tokenized asset itself, so that's the instrument, tokens, and then you get the investors that hold on to that. And the arrows are all about control, so who, which entity, what kind of control they have. In the case of the investors, it's using non-custodial private keys, just like any Bitcoin or any kind of distributed ledger approach. And then down at the bottom here, this is where the more, all the different specialized functions come into play. So this is the contract administrators I talked about before, the identity oracles, authority oracles, and showing the kind of flexibility that they have in terms of the authorization schemes. So how do they interact with this contract? What are the control measures? Is it distributed in a sense? Like, do you have 3 of 5 directors needing to sign off on important actions? And so ours is able to do anything basically, but the key part there is it's ultra, ultra secure and very, very flexible. And just on this too, I think the non-custodial approach, so if you look at Coinbase is a good example, so they're a custodial wallet. There's a lot of problems that approach, and we think this non-custodial approach can really, really be pushed in a way where you get the user experience to be on par with any traditional fintech today. So it's easy to onboard, it's secure. It can be done in a way that if you lose your keys, you don't actually lose your coins. That's a really important piece, and that's part of our protocol and part of our approach. And then in addition to that, we think it's a better security architecture. It's an upgrade to existing tech today, traditional financial systems. So this is what we see this as being the default approach that every bank, every enterprise kind of solution will take in the future, and it's a really big step forward once you appreciate the details. So in terms of value proposition, so this is going back to like, why are we doing this? Why are we getting smart contracts into the fold here? And really it's about improving the overall user experience. So better, faster, simpler. That's the whole point of software in general. So what we can do and what we're trying to do here is bringing all these tools that currently exist today, so Word, Excel, DocuSign, Adobe, Carta, all these kind of email even and Drive, and consolidating them to a single platform where every piece of data has a single source of truth. So if that piece of data gets updated or changed, everything that depends on that piece of data will then be updated in perfect real time. So this is a really big step forward. In this world, the current world here, when you look at all those tools, you have to manually adjust everything, right? So if there's a change to the contract, if someone issues new shares, then you have to have someone manually going through that, recognizing those details in the contract, and then updating the spreadsheets, which there might be 3 or 4, cap tables, registers, the like, and they might have to update by email, by sending out new instruments, new share certificates and the like, and then you might have to update Carta and other tools like that. So you have probably 5, 6, 7 sources of truth that you can consolidate to one, and what you get then from that is automation. So when one change happens and it's authorized by the contracting parties, everything gets automatically done perfectly. So you can get a whole new breakthrough in terms of cap table management. Everything can be automated. Whereas today it's still very, very manual. You can have something that you don't have to do, you don't have to manage these registers at all. So big, big step forward. So this is our app, and the reason why I brought this in here is I really want to give you a sense of what the user experience is like and kind of show you where this information is brought together and how the experience is going to look. So if you've started a business, I'm sure a lot of these concepts are going to be very obvious to you. You've probably dealt with them in various capacities. But this example here is really showing what it looks like from an issuer. So if you're issuing a company, if you're issuing debt or you're issuing equity instruments, you've got to kind of keep track of all the holders, what their positions are, what you owe on them, when your next interest payment is due, how much has already been paid to date, if there's any late payments, if there's any disputes. All of that is now on-chain, single source of truth, and this is what you the dashboard that you can present. Now in the private capital markets today, you cannot get this experience at all. It's all basically in people's heads and based on contracts that are disparate. There may be 10, 15 contracts involved in this that you have to go through, open up, read, process, memorize, and kind of keep track yourself. And everyone has to do that as well. So this is a big, big step forward in digitization. So what does a smart contract look like? What are we talking about here? So you'll notice this is our visual representation. This is our user interface for it. It's taking the terms and conditions, codifying where we can. So what does codifying mean? Codifying means standardizing, essentially, using a symbol to represent something bigger, a bigger concept that makes it more digestible. So you can start to standardize around it. You can process things automatically. So an obvious example, if you look at the top header there, so this is a section that's common to all contracts, governing law, jurisdiction, right? So if you look at any contract today, they'll always have the choice of law, governing law in there, but it'll always be in a non-standardized form. So you're talking like a full sentence or two in legal prose that every lawyer has a different style, a different use of terminology, different phrasing, but essentially all means the same thing. And so what you can do is by creating a standardized protocol that effectively forms a master agreement, you can have just the laws of state of Delaware, and when you go to the protocol, it gives you the full legal prose that lawyers can then digest if they need to go to that level of precision. But for everyone else, it saves them the time of reading it, it saves them the time of that complexity of interpreting it, making sure there's no tricky language in there. And so that starts to apply to more than just those basic concepts. There's actually a lot more that you can do. And so when you move down into the instrument section, so these are your tokens, the ownership rights, if you will. In this case, this is an unsecured note, debt security. So you can start interest payments, payment schedule, collateral, transferability. These things become very easy to understand, and they become across all these different investments. You can right away recognize what that means and what the impact is to you, an investor. And so again, all the legal precision is at the protocol level. So you don't lose anything by going this route. You just gain in terms of simplicity. So it's a big important point. I'll move on in a second. I'll share more about the ones below, but I think the real key thing here too is the automation that comes from it. So when you get these codified terms, particularly around the instruments that vary by instrument type, this is where software can pull out the details and can give you novel and real-time insights. So for example, if you've got, today this is the experience that people go in the private capital markets. If you lent someone some money, you pretty much have to send an email to your lawyer to ask them when the next coupon payment is due, and you need to compare that to bank records. So it's a manual process. You have to keep track of it yourself. Maybe you do a spreadsheet. With this, everyone knows exactly when the coupon payment's due, if it's been paid before, if it's late, but how much has been late, and therefore you can get all these real-time insights, these real-time notifications, and what that can do is start to push the complexity of contracts. So because it's so easy and so cheap to actually engage in complexity, really complex contracts, many contracts, one person can manage a lot more and do it a lot cheaper. So this is a big step forward. So moving down into the different sections of a smart contract, so this is what rounds out and gives all of its precision, is variables and defined terms. So these are just what you expect in a real contract. You get dictionary defined terms. Those are critical because on a per contract basis, they might have a very specific meaning, very specific nuance. And so what we do here is we just standardize the structure of it so that everyone can interpret it very quickly. And then we link those terms, if it's a variable, it's very similar to defined terms, but it has a type against it. If it's a defined term, it's just an English word. But we actually link it in the body of agreement. So the body of agreement is where the legal prose is. This is where the human readable components are, but you're embedding those defined terms and those variables in there, and therefore you can start to templatize things more easily. You can start to structure and repeat the contracting processes in a way that's much more predictable. And I'll just say on the variables, that's really about like a type that you want to embed and you want to define explicitly, but it's something that machine readable, machine enforceable. So you have like a party or a price or an event that oracles can specify. So that's where you lay those out. And I've actually missed one on the top here. So oracles, that's what I was talking about before, is the identity oracles and authority oracles. So the way that we design this is the issuer of this contract can specify who the oracles are for their contract. And so they can say, I've got a broker dealer that we're working with or a transfer agent. You can just literally specify them there. And then everyone that becomes a counterparty to that contract knows from the outset who that party is and what influence they can have and what rights they have to kind of exercise their authority. So again, structuring it, standardizing it, making it much more transparent, bringing all the information into a much more accessible user interface. So the tokens part, so the thing that I've de-emphasized as in importance is still very important, but this is what a treasury might look like with tokenized instruments. So rather than thinking in terms of just holdings and seeing the number go up, we're looking at the full breadth of all the instruments that are important. So you can see here I've got assets, liabilities, equity. So those are the three sort of components on the balance sheet, and that's what these instruments essentially form to any entity that's either issued them or holds them. And so this case here, we're looking at LP interests, so limited partnerships, a common structure for funds. And so these are really equity instruments that have been issued by this particular entity, but for another entity who's holding those, it would form an asset. So this is kind of just really a live balance sheet, if you will, with tokenized instruments at the base level. And this is the foundation of triple entry accounting beyond just the means of payment. So beyond cash, this is bringing all of the instruments into the fold. So peer-to-peer trades, atomic swaps, a term a lot of people have probably heard. Our protocol can do this. Everything's fully on chain. So we're talking about not only the negotiation and the execution part on chain, but also the clearing and settlement. And to speak to some of the question earlier about the performance of this, we operate on the basis of 2-second clearing and settlement. So this is us broadcasting to the blockchain network. Our platform will sample all the nodes, and if we get a confirmation from all the nodes that they did validate the transaction or the transaction and they've accepted into their mempool, when we do both a reasoning out of the risks, so we had a whole paper done on the motivations, the practicalities of operating a node, the likelihood of it being accepted from a rational perspective, and then we also tested that hypothesis and that reasoning against the empirical data. And essentially we can get to 99.9999999% reliability at any value for if certain conditions are met where you get that acceptance from all the miners, and you've tested and looked for double spends. So if you see no double spend attempts within 2 seconds, that holds true, those numbers. So these are very, very compelling, very robust numbers. We're talking better than traditional financial systems today. So it's really, really important to note. So again, this is a big step forward, and that's near real time. So you basically can operate even at a real-time gross settlement basis, so all the way down to like the core infrastructure of banking with very, very small payments, micropayments, all the way up to any type of transaction with any type of security at exchange level, ATSs, all the like. Everything operates on the same basis in incredible performance, with incredible granularity within 2 seconds, and that's on a global basis. So this is, again, a real big step forward. In addition to that, what's unique about the way that we've approached this is that you can do a lot more than just one instrument for another. You could do potentially 50 instruments involved in a trade, and you could do it with 50 counterparties, and they could be going in any direction. So you can get very complicated trades. Now, there's some unique, novel use cases that make that compelling, but I suggest most are going to be just basic party trades. But there are some use cases as well. And so here, just again, rooting this in real financial terms, US dollars, so these are on-chain currency tokens. And you can see below there we have an instrument or asset pay mail address. So this is what we think is the new way of addressing instruments. It's sort of different to what most people think, which is a ticker symbol. Today, most people say, well, you know, if you got an instrument you want to trade, you have to look for a ticker symbol, and that's how you identify it. We think that's not practical when you go beyond the public markets. Private markets are much more complex. There's way more instruments. And we think this is the right way to do it. So when you can see the US dollars, you have what they call the asset alias, if you will. And on the right there, that's the actual issuer. So you got domain-based issuance control and association and all the security elements that come with that. So you can essentially look up Amazon.com, what instruments they have, and you'll see all the shares, different preferences, and things like that. So that's a way of identifying, discovering it, and addressing it. Yep, nothing more to say on that. So just to kind of really speak again to the value that starts to become apparent when you build on this foundation, you can start to look at all of the commercial activity between these entities over time. And again, triple entry accounting, everything is a single source of truth on chain, but you get really complex type commercial events. So when you go to a bank account today, you have a credit and debit and not much more, right? That's all you can really see. And sometimes you can embed in the memo or in some of the descriptions extra data, but it's non-standardized. It doesn't cross between entities. That would be a very bespoke kind of solution that they would sort of dictate with their payments and receipts. in this case, and with our protocol, you start to get into things like issuance events, redemption events, distribution events. So these are events that are codified that everyone can make sense of, and therefore all the software associated with it can then instantly recognize and do the books automatically, update the registers automatically, and again, this is a huge step forward in terms of automation. And this is kind of really just showing you a visual UI of what it might look like to be an authority oracle, freezing or confiscating assets, and what the holder or the issuer might see as well. So an example too here, so we've got municipal bonds, Chicago Midway Airport, the top there on the left, 25 bonds. So the Department of Justice, and that's their pay mail handle, has essentially freeze order targeted the instrument. So those 25 have been frozen. So this might be, at the bottom you can see the memo, compelled by court order, and they give a reference to the court order. So this is what we might see in 5 years' time, the entire system operating on chain. And this is kind of the framework that you'll see. So pretty clean, pretty sensible, and again, much more accountable. So support for novel and complex use cases. So quite often in securitization, even if you tokenize it, you've got a complex set of legal structures, like legal entities that kind of wrap up different things and accomplish different goals. And there's governance elements to it as well. But you end up with just tokenizing the final instrument of the top level entity. So in this case, on the far side here, it might be a unit trust that wraps up a few entities below it that holds the instruments or hold the assets that you're interested in trading. And you would just tokenize that final piece, but there's a huge amount of complexity underlying it, and that complexity can be very significant in terms of financial risk. And even, I mean, there's examples in history, 2008 mortgage crisis, a lot of the CDOs and complex derivatives, they're very, very complicated, and people just didn't have any transparency as to what was going on underneath it. What we can do is we can do smart contracts across everything, and so they're all interacting and all transparent, all standardized, so that if someone does want to go in and poke and look for these details, they can do so very, very easily in a way that's standardized. It's not a 500-page document that is completely different to every other document they looked at, and is going to take weeks and weeks to process. We can start to have software tease out what's standard and pick the things that are unique and bespoke and just present those things to you so you can assess the risks. So this has really, really profound implications, I think, on stability of the financial markets when you start to bring in all those derivative contracts and things into the fold, and so that they're all on chain, in the public domain, fully transparent, interactive and composable.
Great to see you, James, and great presentation. Question in regards to the treasury there, because I know like a majority of people, when they hear like this level of transparency, there is a bit of fear there, and they go, oh shit, like Big Brother's kind of been able to see every move and everything we do in the whole direction there. When it comes to an entity with the treasury there or your wallets, do you have the ability to have brand new addresses within that for every time there's a transaction? That way you're not always using the same address. So that way from the outside in, if someone's to know that that's your address, they can't see everything else that you've got going on. Is there that kind of, I guess, proxy there to be able to have an element of operating in the private?
Yeah, absolutely. It's a great question. A question we get all the time from our customers. So what we have, and this is, I think, a lot of the good wallets will do this as well. So it's not unique to us. We're not pioneering it. But essentially, it's the concept of never reusing address. So when you're looking at the public ledger, you can't really make sense of who owns what, who's transferring what. And we employ a lot of algorithms that kind of obfuscate even further. So we randomize the values that are being sent, and we spread them across different output values and even different transactions, depending on the sensitivity and the kind of the use case itself. But what you get to is practically no one can make sense of what's going on. Like, you can't tell the difference between someone reorganizing their own wallet and just shifting things around back to themselves, or paying someone else, or paying 10 different people. You just cannot tell. And there's a lot of math and sort of theory behind this, but you can get to a level that's just as private as traditional infrastructure today. So there's really no concerns at all.
Yeah, that's really cool. When you look at that there, obviously that's extremely beneficial to big business and whatnot. For the average Joe, having something like this as their back end for their banking, tax, accounting, and all the rest of it looks like it's absolutely amazing. How far would that be away from having, average person being able to utilize something like this as their wallet and account records for their back end?
So it's kind of tough to say exactly when this will happen, but we've sort of got all the pieces in place now to make it compelling for everyone involved. So this is not about the banks needing to fear this tech coming. It's not about investors or holders or one of them not getting a benefit out of this. So it's really a compelling value proposition for everyone involved. And so you can take even the likes of bank accounts today, which are really, it's a form of debt, right? It's a demand deposit you're loaning to the bank, and they're keeping a record of that loan and paying you interest in return for it and using it as working capital. You can turn that into a tokenized instrument, right? So tokenized bank account, tokenized demand deposit. So you're bringing that on chain. You're still getting interest. The banks still get to control a lot of the money and use it in the economy in terms of investing and management of that working capital. But you get the benefits of being able to have these instruments interact with smart contracts and other instruments and sort of everything that I showed you there, better reporting, better insights. And so we're actually talking to a lot of banks, like real big players, and they're starting to become very interested, obviously very slow to move. But the path forward for them is not too different for, say, like a fund coming on, being an issuer, logging in, specifying the instruments they want to, like the LP interest, let's say, or the equity instruments, and just issuing. The same process, the same steps apply to a bank as well for those types of instruments. And then on the flip side, for customers using it, it's the same experience. So we actually think that at some point, this is going to be the standard that everyone operates on. And so bank accounts will be upgraded, if you will. And we think the buzzword is going to be smart contracts in about 5 years in fintech. So along these lines. So we'll see, but it's coming for sure.
That's cool. Next question.
Thanks for the presentation. I would like to ask one question. In the presentation, you talked about your smart contract is very. The key feature of the smart contract is it's very enforceable, right? So I probably have missed something, but I would like to get further details of how are you going to enforce your smart contract. Do you still rely on the traditional authorities to enforce the smart contract? Say, taking the example you mentioned in the presentation, like releasing a fund to a third party, if the third party refuse to execute the contract, they've committed it on chain, how do you enforce the smart contract?
Sure, yeah, great question. So the way that we've architected it is the agent is operated by each issuer, right? So we see this as a natural fault line of incentives, responsibilities, where they naturally have to take responsibility for sort of these records anyways, and that's where the government places on, that's where the national relationship. So the agent operates, the issuer operates an agent, and that's almost like an email address or email service or a mail transfer agent, and they interact with the blockchain on a request-response basis. All the authority oracles, identity oracles I described before is fully configurable and optional, so you don't have to have that. You can operate on a similar basis where nothing can be confiscated, nothing can be frozen. It's up to the contract issuer themselves and obviously the parties that kind of become holders. It's also resistant to jurisdictional risks. So if an agent was managed by a Chinese company or Korean company, you couldn't have the American government interfere. There's no possible way, because the only interactions with that agent and the blockchain is censorship resistant in a sense, right? So it's kind of like allows the whole global world to have their own little private permission chains that are jurisdictionally specific to the issuer themselves, but it doesn't interact with each other, but it interacts on a protocol basis. So where a smart contract wants to interact with another one, like through an atomic swap, the protocol exists and the mechanism exists for them to do it, but you don't give up sovereignty, you don't give up control. So it's a very, very powerful, it kind of takes the best benefits of being distributed, decentralized, and kind of embeds it into the contract, but it gives options to allow, regulated authorities or regulated entities to come in and do their work on a permission basis. But you can even spread that across jurisdictions. So you could have a contract that's fairly global in nature. You have investors from around the world, and you allow a broker-dealer from the US as well as a broker-dealer from Italy, and they have their own sort of Venn diagram of control. So they just deal with their subset of customers, and they have no more additional scope. They can't go beyond just their customers, but they're still able to interact with the others. So I appreciate there's a lot of nuance and details there that it's hard to get into, but does that kind of at least give you a sense of
Is it the issuer or the miner who is able to do
the issuer?
The issuer.
Yeah, the issuer. But the issuer controls it. They can delegate that out to the authorities if they want to.
Okay, thanks.
We can chat later if you like, and we go into details.
Yeah, thanks.
Thank you. Yeah, it's a great talk.
Thank you.
My understanding is that you have a smart contract and you also have a corresponding human readable contract, right? So my question is, how do you make them work exactly the same?
So how do they interact, kind of thing, or how do they?
So the smart contract normally are written in like programming language. The other one is like human readable, for example, English. Then how do you make sure this smart contract you're written in programming language it implements exactly what is written in the natural language? Okay,
so there's two parts to it. So our contract, so what I prefer to call like the machine, the code itself that's on the blockchain and sort of enforced by the miners, I prefer to call it a script, which is what Satoshi called it. You know, he really thought this through, I think. But then you have, as part of the broader protocol that we have, you also allow for areas where you write the human prose. So it's structured. You kind of say like, this is the human readable part, this is the machine readable part. And so the computer knows what's what. And when it comes to some human readable prose or terms and conditions, you simply cannot convert it to machine readable stuff. It just cannot be done, but you can support it by having it adjacent in the data structures to the machine readable code. And then when it comes to the drafting capabilities of our platform, we enforce those rules. So when the user's drafting their contracts or reviewing them, we prevent them from making mistakes that are contradictory, right? So you get a clear separation of concerns.
So whose responsibility to, like, I guess it requires expertise to separate which part can be written in machine readable code and which part can only be written in natural language.
Sure. So it's really done at the UI level. So it's done like, so we guide you as to what is machine readable. You just select, you configure different options. Like we want the payment schedule or the interest rate to be this. We want the governance terms to be this kind of threshold, like 50% of people have to vote in favor of it. It's this type of voting system. And then when you get to the body of agreements, you can absolutely make a mistake and kind of override that, absolutely. But the way that we've designed our UI makes it really easy. And then in addition to that, we've got like a template library. So it's gonna be a template library not only that we curate and start to kick off, but anyone can contribute templates of their own. So there's a little bit of expertise that allows to create great templates that don't trip over themselves, so to speak, and other people can buy them from them on a very low cost basis type thing. So there's a few strategies there.
Thank you.
No problem.
Any further questions?
It's a very quick question. Is Tokenized hiring now?
We're always looking for really great engineering talent.
So you're mostly looking for engineers?
At the moment, yes. Yeah. But things may change in 6 months. So if you're interested, always, get in contact and develop a relationship. And yeah.
Just behind.
Hi, great presentation. I guess we still can't get away from this authority oracle, right? So just a question about that. When you were outlining this, was it more so to be for the two parties that were dealing with each other, or was it more to satisfy things like government organisations, so perhaps you could be the platform of choice in that? So who were you really trying to satisfy?
So we think that the end user, right, is who's going to be paying the money, right? So you got to build a compelling value proposition for them. So that's issuers and the holders. But our argument is that this is actually what they want. They want something that's useful and meaningful and fully on chain, and that has the best possible value proposition. Now we looked at this from like a first principles approach, and we kind of like delved down into like what are property rights, what are the non-negotiables, And we reasoned out that you absolutely do need some kind of function this way, because if you don't, you end up with a really hacky system that depends on multiple sources of truth. Now, my argument is, even in this period of, there's a lot of gray in the market, like the legal sort of ramifications and the regulations are not certain yet. So even in this period where there's the Wild West, Coinbase and their ERC20 token, USDC, they have elected to not have essentially a freeze or a confiscation function like we've had. But in practice, the authorities have just made them freeze and do these exact same functions anyways, but they do it with an off-chain database, and they just basically let everyone know, don't trade, this is a blacklisted address, this is a blacklisted, these are now frozen. So they are doing it, in fact, even in this gray period, even on the most decentralized network out there, they're just doing it in a really convoluted way where you have to depend on Coinbase's servers to tell you what's frozen and what's not. So in practice, this is what's happening. Ours is more elegant, where it holds Coinbase, in that case, to account. So you can see what they've frozen, what they haven't frozen, and what the reasoning was behind it. So this is really just, really reasoning from first principles, what really needs to happen to push this forward and make a really compelling value proposition, and then extracting the most value from it with the best approach. So that's...
Okay, thanks for that. And then just an add-on to that, with the authority oracle, does that create like a backlog? Will there be a time where I'm understanding that it's going to be more manual, not like the smart contract is?
So it's very automated, in fact. So we have part of our open source implementations is an authority oracle and identity oracle services, and that can be automated to whatever degree you want. So yeah.